Every time you open your Demat account, you see this particular screen in front of you. It says that 9 out of 10 individual traders in equity, futures, and options segment incurred net losses, and each average person lost nearly 50,000 rupees. So the reason this is being shown is because futures and options traders trade recklessly. You wait till the end of this video and I'll make you understand what are the mistakes the futures and options traders are making. This might be a long video, so please save this video in case you don't have time now and watch it later. Welcome back. So friends, we've seen that 9 out of 10 traders lose in the futures and options market. What is the reason? I've analyzed the reasons and I'll be telling you what are the reasons exactly. So futures and options are, first of all, you have to understand it's a derivatives market. Derivatives market means it doesn't have its own value as such. These are contracts which are derived from the underlying assets. For example, if you've got a Reliance futures or Reliance options contract, then it will be based on the spot price of Reliance. Okay, so basically these are, you can say, as the margin trades. What do you mean by margin? Simple concept of margin. If you want to have a bank loan, you 10 lakhs, you want to buy, let's say, a car of 10 lakhs, you give only 2 lakh rupees and balance 8 lakh rupees is financed by the bank. So that 2 lakh rupees is like your margin. So in 2 lakh rupees, you're enjoying something worth 10 lakh rupees. Similarly, in the option segment also, or futures and option segment, you are enjoying something much more than what you have actually invested in. Okay, so we have to understand that the futures and options basically is a margin concept. Okay, so these are trades which are there on margin. And second one is that people are not aware of the futures and options structure. So futures and options are the instruments which have been constructed for basically trading and hedging. So futures and options, they've got again two concepts. One is a call and the put. Now, what is a call? What is a put? What is a futures? How do they work? What is the intrinsic value? What is the time value? How the time value decays? All those is not properly understood by the traders who are there in the futures and options. So if they understand how the structure works, what is the margin in futures? What is the premium which will be charged? How the time decay will happen in the options? Then they'll be able to trade better. Secondly is that the futures and trade options trades have to be taken based on the charts. Okay, that means when you buy a futures or when you buy a call or when you buy a put or when you sell a future or when you sell a call or when you sell a put, the decision will be based on the chart analysis. Okay, so let me show you some charts. So I'm going to show you the charts over here. So this chart, if you see, this is the chart of the Nifty. So in Nifty, on what happened a few days back, Nifty there was a short indication from here, and from here the price fell. Okay, but at this time what happened was that the put instrument which was there, if somebody would have bought the put, he would have made a great return. Okay, but then that return, you have to understand, does not happen every day. The particular instrument over here, okay, specifically if you go for the particular instrument, something like a 25,700 or 25,800 put, you may or may not understand the language right now, but that put would have given you 200% returns. Means something, if it was something like 100 rupees for that premium, then that 100 rupees would become something like 300. Now the options trader thinks that this is going to happen more frequently. And what better than that, if you're getting like 100%, 200% return in a day, and the options trader waits in the hope every day that he's going to get those type of trades every day. But that doesn't happen, right? The next day what happened? Again, the prices came down. So the option trader has to be very quick in the decisions, first of all. And secondly, he has to take trades only when the charts tell him to buy. Another reason, which is a trap for the option trader, is that the option traders can trade with very small capital in something called as a naked calls and puts. So if you buy a call and put, you just have to pay a small premium. The premium could be as small as probably 1,000 rupees, 3,000, 5,000 rupees also. And most of the traders who would like to make quick buck, they don't have large capital, right? So with small capital, if someone tries to trade and tries luck, it might happen once or twice. And whatever money he has earned probably, then all that gets lost by gradually. You would have earned, let us say, 5,000, 10,000 rupees, but with every loss making trade, he will lose like 1,000, 2,000, 500, and over the next few sessions, he loses the entire premium what he had earned in a few sessions. So this is another reason why the option traders are making losses. And then there's this classic reason. Okay, you'll understand what happens with the option traders is that they will exit early from the profitable trades and wait much more longer in loss making trades. So whenever the profit starts coming in, they would exit with a small profit, and then later on they find that had they not exited, the profit would have increased to a greater level. But at the same time, if there is a loss, then they wait in the hope that that loss will be recovered. But alas, that never happens, and then that loss keeps on increasing more and more. The final reason why the options traders lose is because they don't hedge their position. What do you mean by hedging is? Hedging is like insurance. Why do we take insurance? Because we want to protect ourselves. Option traders are high risk instruments. If people don't understand the hedging concepts, then they are most probably likely to take only the naked futures and the calls. So what happens is that sometimes they might see a huge profit, and next few days their profit would have gone, and probably they might end up making losses. But if they understand something called as the hedging trades, so in hedging trade, what happens is that in hedging trades, they would have taken a combination trade. So in combination trade, they would pick the combination of, let's say, a future and a call, or a call and a put, or buying a call and selling a call. So there are some hedging trades by which what would happen is if there is a profit in one, okay, then that profit is protected, okay, because what will happen, the other instrument which is there, that will not allow that profit to be reduced to a great extent. So hedging would simply mean if you have a profit, or if there is a loss in one particular instrument, then in the other instrument there will be a profit, and you end up making a reasonably good return. It may not be a very high return, okay, but which is also many times the high returns are very erratic. Sometimes you've got high returns, sometimes high losses. But if for someone who would like to have a consistent return, then hedging is something which they should be employing. With the above explanation, I'm sure you would have understood that why the futures and options trading traders are losing money. But remember one thing, it said 9 out of 10 traders are losing money. What is the other part? 1 out of 10 traders is making money. That is the best part. Okay, so if you are trading with the things which I told you just now, you are among the 9 out of 10. But if you want to make money from the futures and options, then you have to be that one person who would understand how the markets work, who would understand the charts, who would understand what are the instruments of the futures and options, and of course, someone who will hedge his positions and ensure that he does not go into losses. If you like this video, do subscribe to it and share with your friends. This is once again Paresh Desai, Chartered Accountant from Sankalp Venture. I'll see you soon in another video. Bye.